Let's talk about how everybody is losing money in the markets. Let me tell you why. Let me tell you why everybody's losing. And let me tell you why that if you are losing, you're already light years ahead of where you were a few months ago. Let me explain. We've seen a massive influx in investors, new investors coming into the market over the last couple months. I've talked to them in my personal life. I talked to them at my, in my personal groups that I'm a part of. It seems like over the last few months, we've seen a lot of people coming into the stock market and investment financial markets that weren't here 6 months prior. And I can tell you that I've been in the markets for over 10 years. I've done phenomenally well in some of my investments, and I've done phenomenally bad in others. But one thing that I have learned, guys, is that there are people that enter the market in these little cluster groups that we've experienced over the last few months that have notably gone into a lot of these companies, a lot of these AI companies, a lot of these microchip companies, tech stocks at super high valuations. Now, what's going to happen is that they're not going to be able to digest the volatility that's occurring right this second. Because for one, these new investors coming in are buying the stock at market price, and they're not understanding the complexities behind the other markets that exist, that coexist for these same stocks, like inverse ETFs, like shorting positions. When somebody borrows a stock, sells it, expects the stock to go down, they buy back the stock and return it to who they borrowed for a difference. There's a lot of different things that are on a basic level, things that investors should be exploring right now. There are a lot of things that on the surface layer look very simple. We're seeing a lot of marketing. We're seeing a lot of news articles push investors to push these new investors to purchase these super high valuation stocks that are in some cases 700 to 1,000% up. And I did a video on this on Micron the other day, and it's down about 20% for the week. But the point is not to cherry pick certain stocks. The point is to understand that if you are a new investor and you're investing in the financial markets now, you are light years ahead of the former person you were before you started investing. And I told my friend this the other day because he told me, hey, Chadwick, I've been losing a little bit of money here. I made a bunch of money on this stock, and then now I've lost a little bit, and then I'm playing with profits. And I can tell that this person is going, back and forth into various stocks. Like I know the mindset of this person because I was the same person. You want to relive the euphoria that you got from your first investment, and that's what's happened with a lot of people. A lot of these new investors have gotten in at these super high valuations, and the stock has edged higher, in some cases 100%, which is something that is of euphoric feeling, something that you want to relive. In typical investment world, guys, it's impossible to pick 100% gainers where you're just doubling your money. If investing was that easy, we'd all be rich, living in mansions and driving Ferraris and have multi-million-dollar stock portfolios. But for the humble investor, for the real investor that is new, I think the most important thing that they need to understand is the market dynamics behind what is driving some of these things, okay? What you have is companies like BlackRock, Vanguard that are establishing massive positions in these funds that they're making money off people trading these different funds, and they're using arbitrage to exploit the price differences in between the actual underlying asset. So what they're doing is they're establishing positions in various different position points within that actual stock, within that actual equity, within that actual common stock. And what they're able to do is when this new group of investors comes in at large masses, reading into these marketing campaigns, buying into the propaganda that's being pushed out there on the marketing side, these valuations get shot super up. And then these big companies are able to, like BlackRock and Vanguard, algorithmically, they're able to exit their various positions in these different mechanisms they built out to strong arm the actual retail investor, whether it's shorting, whether it's option plays, puts and calls, or multi-leg strategies on the downside, whether it's inverse ETFs that they're controlling a large portion of. So they're able to use that arbitrage, and really they don't really move their positions. They move their positions algorithmically, which allows the retail investor to sit there and trade back and forth until they lose everything, and everything they lost gets sent back to the corporation, the private company, right, or the mega investor, in this case BlackRock, Vanguard, and so on. So for new investors out there, you are doing amazing. You're doing great, because you're investing your money, which is light years of where you were at before you started investing. But one thing that you need to understand is you need to understand the complex nature of how these derivatives and financial markets work on the back end. That way you can utilize your own liquidity to strategize plays and hedge and mitigate your risk. All right, this is for any new investor, guys. Reach out, let me know, and we'll talk to you in the next one.